Hi everyone, in this video I'm going to show you the principles behind covered call investing in my own words. So to start with, I'm going to say that I am not a financial advisor and I am not a professional trader. I don't work for Wall Street or any other financial place, and I am just a retail investor that would like to share his understanding and his journey towards financial freedom through mostly covered call investing. In the past 2 years, I mostly invested in dividend stocks, but today my portfolio on interactive brokers, which is at about 80,000 US dollars, is mainly comprised of companies that, in my opinion, deliver a decent income through covered shares. So as you can see, I have a 100 shares of Airbnb. I am building to reach 100 shares of Amazon. I have some growth stocks that some of you may know. I have other dividend payers that for now are too expensive for me, for which I cannot get 100 shares because I am still building my wealth. And there are different types of covered call companies that I'm investing in across industries so that I don't get too tied up in one industry. But in this video, I'm going to show you my understanding of how these covered calls work. So I'm going to go in my watch list, and you can see that there are only big caps or the massive indexes, which are the SPY and the QQQ. And I only focus on big companies. My rule for covered call investing is to only target large caps. And I have set up a certain set of criteria to invest in covered calls that I can share with you in another video. But in this video, I just want to share the principles as I understand them behind covered calls. So let's go on the Amazon ticker. As you can see today, Amazon is at 221 a share. We'll go on the options chain. And basically, if you want to very simply understand how covered calls work, and you need to understand first how options work. In the world of options, any trade has to be done over multiples of hundreds of shares. And the minimum that you can start with is 100 shares. And my understanding of options trading is the following. Whether or not you hold a share, you can bet that a stock, for example here Amazon, will go higher or lower than a certain price. And that certain price is called a strike price. It is different than the current price of the stock. And for example, here on Amazon, the stock closed at 221 US dollars on December 31st. Today we are January 2nd, 2025. And the opening price when the market opens in 3 hours will be 221 US dollars. So this is the price in the market, the one that people use as a reference when they trade on the spot market. But there is another market which is called the options market, in which you can bet on different prices, and you can go very low or you can go very high. And your decision as to which strike price you're going to choose is going to influence the income that you're going to make or the profit that you're going to make. So in options trading, there are two sides. One person bets that a stock will be higher than a certain price, the strike price, for example here 2020 or 2025, and another person is going to bet that the stock will be lower than this price. And it's basically a game of betting. If you want to understand it in very simple terms, mathematicians and finance people have invented different ways to measure the probability that a certain stock will be higher or lower than a certain price. And basically, people bet for or against that idea of the price being higher or lower than a certain price. And this is where it's very interesting because when you, for example, this stock Amazon is at 221. if you come on this options chain and you say, no, Amazon is very cheap and I really think that it's going to be higher than 225 US dollars, what you will do is you will buy something called a call option. A call option is basically a bet that the stock will be higher than the price, and your interest is very simple. Because you think that the stock will be higher than 225, you want to buy it at 225 at expiration and sell it at a higher price after this contract that you will sign with someone expires. But if you bet that the stock will be higher than 225, just like in anything in life, there is a counterparty, meaning someone that will think that the stock will not go higher than 225. So that person will bet that it will be lower. And how does it work? You say, for example, imagine you are with your best friend Ben, and you tell him, listen, Ben, or listen, Charles, or listen, Hamid, I bet you that the stock will be higher than 225. And if the stock is higher than 225, I'm going to buy your shares from you. Hamid or Ben or Charles tell you, okay, I actually own 100 shares of this stock, and if the stock is higher than 225 US dollars, here Amazon, I'm going to sell you my shares for 225, and you can make the profit that you will make if the stock goes to 230, 240. That's in your pocket. But in exchange for allowing you to buy the shares from me, meaning the 100 shares from me, you need to pay me something. And what's interesting, what you see here, the market is closed, so you will only see the last price that was negotiated. If the stock is at 221 and you bet that it's going to be higher than 225, you are willing to bet here 387 US dollars, meaning 3.87 dollars for one share multiplied by 100. You're going to bet this money, saying, I will pay whoever wants 387 US dollars, but if the stock goes higher than 225, they will give me their shares at 225, and they will not benefit from any price increase beyond 225. And this is what's magical. Most people that buy a call, meaning most people that are willing to bet 387 US dollars that the stock will be higher than 225, most of them lose on their bet. This is statistical, it's been ongoing for decades now, and the statistics say between 80 to 90% of people who bet or buy a call option lose. So when you hear this message, what do you immediately say? You say, if I know 80 or 90% chance that I'm going to lose this trade, why do I even make the trade? Here, this is where it becomes very, very cool. You can be on the other side of the trade, meaning instead of betting 387 that the stock will be higher, you can say, I'm willing to sell my shares if they increase higher than 225. And this is where you start making money, income, by getting the 387 US dollars. But the condition, if you want to be safe, is to own 100 shares of Amazon and wait for the stock to go in a certain direction to decide if your trade is winning trade or a losing trade. So this is the principle of covered call investing, and I will show you when the market opens how this goes in real terms. So I hope you like this video. Click and subscribe, and follow me for more content.